Welcome to today's deep dive. Our mission for you today is to basically map out exactly how capital is migrating right now, especially as, these traditional sovereign and logistical systems really begin to fracture.
Yeah, and we're looking at market intelligence that was finalized on March 13th, 2026. And, I mean, the picture it paints it's pretty intense.
Oh, absolutely. It's this profound collision. Like on one side, you have these physical, kinetic bottlenecks, right? Global energy and trade corridors literally choking.
Right.
And colliding right into that, we're seeing these algorithmic breakouts in the digital asset microstructure.
Yeah, operating with just cold mathematical precision.
Yeah.
It's a complete structural divergence. You've got Western governments trying these really desperate logistical interventions just to maintain control.
While massive pools of wealth are quietly sliding away from fiat infrastructure.
Exactly, moving straight into non-sovereign scarcity.
So we're going to trace this whole journey for you, from a devastating maritime blockade in the Middle East to a $50 million disaster in a decentralized liquidity pool.
Which is a wild story, by the way.
Oh, it's insane. And then all the way to this unprecedented merger of permissionless finance with the absolute apex of U.S. political power. But let's start in the physical world.
Good place to start.
Right. So geopolitical risk premiums have just violently repriced. Iran's new supreme leader, Mojtaba Khamenei, issued this broadcast formalizing a persistent blockade of the Strait of Hormuz.
Yeah, and we've seen tensions there before, obviously.
Right, but what makes this specific broadcast an actual structural breaking point?
Well, it's the explicit formalization of asymmetric warfare. It's not a threat of a temporary disruption anymore.
Okay.
It's a stated, persistent blockade enforced by ballistic anti-ship missiles.
Wow.
Yeah. And when you trap roughly 20% of the global daily crude supply behind a kinetic wall like that, institutional commodity traders instantly recognize it.
Because it's a hard physical reality that no policy can just, wave a wand and fix.
Exactly. You can't print oil.
Right. And the market reaction reflects exactly that. Brent crude just surged decisively past the $101 mark. So, any narrative we had about disinflation earlier this year, completely erased.
Oh, gone. Yeah.
It's as if the global economic engine is, simultaneously losing its fuel supply while the gears are completely seizing up.
That's actually a great way to look at it. Because at the exact same time oil crosses $100, the US BEA revised Q4 2025 GDP drastically downward.
From a sluggish 1.4% all the way down to a stagnant 0.7%.
Yeah.
I look at those two numbers together, crude spiking, growth dying, and I just have to ask, how do central banks even begin to respond to this?
Well, the short answer is they don't.
They just can't.
They can't. That's the mathematical trap of structural stagflation. The central banks are completely paralyzed right now.
Yeah.
And think about their mechanics. Their primary tool is the interest rate, right?
Right.
But look at the bind they're in. They can't cut interest rates to stimulate that collapsing 0.7% GDP.
Because if they do, they pour gasoline on the oil-driven inflation that's already ripping through the supply chain.
Exactly.
But, they also can't raise rates to fight the inflation, can they?
No, because raising rates further would trigger a systemic sovereign debt crisis. You have to factor in the current pace of deficit spending.
Right, the interest payments.
Yeah, the cost to service the national debt would just become mathematically unmanageable. So their monetary tool belt is completely empty. The dials they usually turn, locked in place.
Which means the executive branches of government are sort of forced to step in, right? And they're resorting to these incredibly desperate logistical interventions. Like, I was looking through the intelligence, and I keep seeing these references to the Jones Act.
Oh, yeah. This is huge.
The Trump administration is actively considering a 30-day waiver of this act to curb domestic fuel prices. But, why are they looking at a 1920s maritime law to fix a 2026 energy crisis?
So the Jones Act basically mandates that only American-built, owned, and crewed vessels can transport cargo between U.S. ports.
Right, it's heavily protectionist.
Fiercely protectionist. It's meant to ensure a robust domestic maritime industry. But by considering a waiver to allow foreign tankers to move domestic fuel, and they're actively fighting domestic maritime unions to do this, the administration is signaling profound logistical distress.
Because waiving that, that's usually a lever reserved for catastrophic natural disasters, right? Like if a major hurricane completely wipes out the Gulf Coast refineries.
Precisely. Using it now proves that sovereign governments are just hitting the absolute limits of their traditional authority.
Wow.
And that logistical distress, it's being compounded on a global scale, too. The USTR just launched a sweeping Section 301 investigation into 60 different countries.
Over forced labor practices, right. But here's where it gets really interesting to me. This list isn't just adversaries. I'm seeing critical allies here. The EU, Japan, Canada. Are they actively fracturing their own cooperative trade architecture?
They are. They're basically forcing a massive multi-billion-dollar supply chain audit. By targeting the failure to ban forced labor inputs in raw commodities, they're mathematically guaranteeing elevated baseline costs.
Because you have to rip out the cheap materials.
Exactly. Corporations have to rip out those cheap raw materials from Tier 3 suppliers, find more expensive compliant materials, and then pass that elevated cost directly to the consumer. It structurally embeds inflation.
So you've got energy inflation from the blockade, logistical desperation at home, and now engineered trade friction globally.
Yeah.
And all of this is happening under the umbrella of an expanding military theater. In Operation Epic Fury, a U.S. Air Force KC-135 Stratotanker just crashed in Iraq. 4 fatalities.
Awful.
It is a terrible human tragedy. But there's also a strict macroeconomic calculus here that we need to unpack. The intelligence points to this as an example of, quote, fiscal dominance. Walk me through what that actually means.
Yeah, so fiscal dominance occurs when the government's debt levels and spending requirements are just so massive that they essentially force the central bank to prioritize funding the government over controlling inflation.
Because they have to keep the military running.
Right. When you look at the continuous expenditure of precision munitions, the operational tempo degrading these airframes, and the absolute necessity to replace massive strategic assets, like that Stratotanker, which is the logistical backbone of aerial refueling, none of that is cheap.
And they can't exactly just raise taxes overnight to buy a new fleet of Stratotankers?
No, exactly. It requires unbudgeted sovereign debt monetization. The government issues the debt to pay for the hardware, and the central bank ultimately has to absorb it.
Which just expands the money supply.
Right. So when you combine war debt monetization with forced supply chain reshoring and paralyzed central banks, you guarantee systematic fiat debasement. The currency inherently loses purchasing power.
Which I guess brings us perfectly to the great cryptographic rotation. When physical supply chains fracture and fiat is debased to pay for war, capital has to go somewhere. And we are seeing Tier 1 fiduciaries aggressively rotating into non-sovereign scarcity.
The structural shift is massive.
Yeah. Looking at the Bitcoin microstructure over this 24-hour period, it executed what the data calls a textbook algorithmic expansion. It dipped down to exactly $69,459, then shattered overhead resistance to stabilize above $71,800.
Right.
But the notes specify this wasn't a cascade of forced liquidations. What's the mechanical difference there?
Okay, so a liquidation cascade is panic. It's when leveraged traders are forced to sell by the exchange because their collateral drops, right? It causes this domino effect.
Like everybody gets wiped out.
Yeah. But what forensic order flow analysis confirms here is entirely different. This was strictly a liquidity hunting maneuver by sophisticated quantitative trading systems.
Wait, so they purposefully pushed the price down just to trigger resting stop-loss orders?
That is the architectural reality of modern algorithmic trading. They hunt for pockets of sell orders. But the really crucial takeaway is that the downward pressure was instantly absorbed at that exact threshold.
Because the big players were waiting for it.
Exactly. It proves that institutional accumulation engines are maintaining these really dense walls of limit bids. They capitalized on the macroeconomic anxiety to just vacuum up the asset at a discount.
And they are buying in massive size. Total aggregate trading volume exceeded $50 billion for the period.
$50 billion.
We saw a 4th consecutive day of spot ETF inflows totaling over $53 million. BlackRock's IBIT alone took in over $46 million of that.
And that demographic distribution is heavily asymmetrical. It confirms that macroeconomic allocators like your sovereign wealth conduits, your massive pension funds, they're utilizing the most liquid regulated vehicles to systematically warehouse the asset.
They're just looking at the global pressure cooker and completely ignoring the short-term geopolitical noise.
Completely. They just want base layer scarcity.
But, you know, what's really fascinating is the divergence at the corporate infrastructure level. We're witnessing this massive split in how apex entities view the underlying hardware of the digital economy.
Yeah, the core scientific and metaplanet strategy.
Right. Let's lay this out. Core Scientific, huge digital asset mining conglomerate, just secured a $1 billion loan from Morgan Stanley.
Which is huge.
But they aren't using it to mine more Bitcoin. They're aggressively pivoting to build AI data centers. And they're liquidating their treasury of over 2,500 Bitcoin to finance it.
So they're basically doing a massive offloading of digital gold to build AI infrastructure.
Exactly. They're selling their digital gold to build the pickaxes for the AI gold rush. But then on the exact opposite end of the spectrum, you have Metaplanet in Japan. They are issuing highly sophisticated floating rate equity specifically to buy more Bitcoin, aiming to hoard like 210,000 BTC by 2027. So one company is selling their Bitcoin to build AI, and another is borrowing traditional fiat to hoard the exact same Bitcoin. How do these two completely opposite strategies exist at the same time?
Well, because they're solving for two entirely different macroeconomic realities. If you look at Core Scientific first, what this pivot proves is that permitted, energized power capacity is now the ultimate bottleneck.
Power excess is everything.
It is. The fact that traditional Wall Street capital is pouring billions into Core Scientific capital demonstrates that Bitcoin mining infrastructure has immense, highly liquid salvage value in the traditional tech sector.
Because they already have the massive power agreements with the grid and the high-density cooling systems that AI companies are desperate for.
Yes. And that dynamic places a fundamental mathematical floor under the enterprise value of the mining industry. But then look at Metaplanet.
Right, in Japan.
They're operating in an environment where the national fiat currency has structural weaknesses, and interest rates have historically been engineered differently. By issuing floating rate equity, they're leveraging legacy capital markets to seamlessly convert fiat into cryptographic scarcity.
So it's basically an arbitrage on the debasement of the fiat currency itself.
Exactly. It's a brilliant structural play.
So as these massive institutions acquire the base layer asset, they're naturally demanding native yield, right? They don't just want it to sit there. And BlackRock just launched ETHB, the iShares staked Ethereum trust.
Yeah, seeing 15.5 million in day one volume.
Which is essentially putting guardrails on crypto yield for traditional investors.
It fundamentally bridges that technological chasm between decentralized proof-of-stake consensus and legacy fixed income models. By staking the underlying Ether and passing 82% of the gross staking rewards to shareholders, BlackRock has basically formalized the concept of the internet-native bond.
Which, for a fiduciary managing a massive pension fund, being able to get non-sovereign yield without having to touch a private key, that's a paradigm shift.
A permanent one, yeah.
But, okay, here is the massive catch. The regulated wrappers are smoothing the on-ramp, but what happens when big money tries to skip those guardrails and go straight into permissionless finance?
Oh, man.
We have to talk about this $50 million AMM disaster.
It is the ultimate cautionary tale.
Yeah.
Just a mandatory tuition payment for fiduciaries trying to navigate DeFi without quantitative risk management.
I mean, let me walk you through the numbers because they're staggering. An unidentified entity tried to swap $50.4 million in USDT for AAVE on a decentralized front end,
Right.
bypassing all the slippage warnings on their mobile device. And the routing architecture pushed that massive $50 million order through a SushiSwap liquidity pool that only contains $73,000 in total liquidity.
Yeah.
I mean, it's like trying to force a massive freight train through a single-lane bank drive-through.
Yeah.
How does that even interact mathematically?
It just triggers an immediate catastrophic price impact. Decentralized automated market makers, or AMMs, they don't use order books. They use a constant product formula.
I've always visualized it like a seesaw. If a pool only has a tiny bit of weight on both sides, like 73 grand, and you drop a $50 million anvil on one side,
The math forces the other side to shoot up into the stratosphere just to keep the underlying formula balanced.
and that astronomical spike is the price the user ended up paying.
Exactly. The code doesn't care about the real-world spot price of the token. It only balances its internal ratio.
But it gets worse, right? Because they didn't just get a bad price due to the math. Someone actually profited from this mistake in milliseconds. An MEV bot Titan builder executed a sandwich attack. How does that actually work here?
Okay, so to understand a sandwich attack, you have to look at the mempool. It's basically a public waiting room for transactions before they're written into the block. The bot monitors this room, and it saw this massive $50 million anvil coming.
Because it's all broadcast publicly.
Right. So the bot instantly calculates the inevitable price spike. It pays a slightly higher network fee to jump the line, buying the AVE tokens in the pool milliseconds before the massive order hits.
Oh, wow.
Then the user's order executes, artificially inflating the price into the stratosphere. And finally, in the exact same block, the bot instantaneously sells those exact tokens back to the user at the absurdly inflated valuation.
So the final math, the user vaporized roughly $49.6 million. They received only 327 AAVE tokens.
Costing them roughly $154,000 per token.
When the market price was, what, $114?
Yeah. And there's no customer service desk to call.
That's the thing. There was no hack, no exploit.
The code worked perfectly. In DeFi, code is absolute law. Inefficiency is immediately monetized by predators. You cannot force monolithic capital into decentralized pools without algorithmic slicing or OTC desks. It just doesn't work.
So we have this environment of ruthless code and borderless capital. But now it has explicitly merged with the highest echelons of global political power.
Yeah, this is a massive shift.
World Liberty Financial,
Right.
WLFI.
Right.
Looking at it entirely objectively, this is a protocol controlled by the Trump family. And they just passed a governance vote, 99.31% approval, instituting a 180-day lockup for staking. Mechanically, what does locking up a token for 6 months actually do to the market dynamics?
Well, in crypto markets, liquidity and available supply dictate price action. By mathematically mandating that users can't sell their tokens for 6 months, the protocol effectively neutralized immediate sell pressure.
Right.
It creates a transient liquidity trap. When the floating supply drops that drastically, it artificially stabilizes the token's price near its 10-cent threshold. There just aren't enough tokens circulating to crash the price.
Makes total sense thermodynamically. But then the governance architecture introduced this $5 million supernode tier.
Yeah.
Staking 50 million WLFI tokens grants the holder guaranteed direct access to the executive team, which includes Eric, Donald Jr., and Barron Trump. And the family receives 75% of the net proceeds. Systemically, what does this structure imply?
The implication is profound. We are observing the explicit monetization of sovereign adjacent access via an unregulated cryptographic token.
Right, because traditional lobbying requires PAICs, disclosures, legacy banking.
Exactly. This architecture bypasses all of that. It completely erodes the traditional boundaries, separating sovereign policy access from private, borderless financial speculation.
And it isn't just happening in the U.S. either. Apex digital entities are operating like this globally. Look at Binance. They just sued the Wall Street Journal for defamation over a February article about Iranian compliance,
citing internal data metrics showing their sanctions exposure dropped by 96.8%.
Right. They aren't just putting out a PR statement anymore. They are taking aggressive legal action.
Because they're no longer passively existing outside the system as these disruptive outsiders. They're proactively utilizing the legacy legal architecture and the political architecture to permanently cement their power.
Wow.
The highest levels of global power now recognize the immense capacity of tokenized architecture.
So let's tie all the connective tissue of this deep dive together. We started in the physical world. Capital migrating away from physically blockaded maritime corridors in the Middle East.
Right.
Central banks trapped by stagflation. Sovereign governments exhausting their tool belts with desperate policies like the Jones Act waiver, facing unbudgeted military attrition.
And all that capital is flowing directly into the algorithmic corridors of cryptographic assets.
Exactly. We saw corporate treasuries financing AI, Wall Street building internet-native bonds, predators extracting millions on-chain, and finally, this technology merging into the absolute center of global political gravity.
The physical machine is seizing, while the digital microstructure is hardening.
Which leaves us with a final concept for you to mull over as we wrap up today. We just looked at the intersection of DeFi and political power, allowing for $5 million tokenized supernodes to guarantee executive access.
Yeah.
If that architecture is already live, how long will it be before traditional lobbying, foreign aid, and even international diplomacy are entirely tokenized on-chain? If the global economic engine is seizing up while the algorithms run perfectly, maybe the people running the engine have already decided to migrate. Thank you for joining us on this deep dive. We'll see you next time.